Hello, everyone, and Happy New Year. It is now 2025, and the goal for any investor out there is to be in a better financial position and closer to our financial objectives by this time next year in 2026, regardless of how the market performs. So, as we all know, the market is not a little pond, it's a whole ocean. It's a very wide place with lots of different companies, and it's nice to have some areas of interest that we can focus on in order to find bargains and good opportunities for the next year. So in this video, I'll be going over 3 sectors that I find the most interesting for the coming year. I'm not going to waste your time. The 3 themes are over here. So the first one is online gambling, second one is private markets, and third one is the data center build out. And here we're looking for secular trends. We're not looking for sectors that will be performing well for 1 year in 2025 and then go out of favor in 2026 and 2027. There's really no point in that. We're not trying to trade in and out of stocks. I want to find sectors that are in a long-term secular trend where 2025 would still be a good time to get in on it early. I really think it's pointless to identify themes that will work for 1 year and then not for the long term. These videos are a lot of fun to do and very instructive for me because they force me to look at the investment universe from a very broad perspective. And also, it's going to help me decide which companies to focus on to add to the rated A coverage as quickly as possible in this coming year. And let's be honest, people also love these types of videos. We love to click on videos that tell us what to buy and what to focus on because at the end of the day, people are lazy, they don't want to do their own research, and it's always nice to have someone on the internet tell you what to buy. So with that, I want to express some sort of a disclaimer. I'm not usually a top-down investor. Top-down just means that you look at the macroeconomics and decide from there what would be a good company to invest in. No, I look at microeconomics of the business itself and then figure out from there if it would be a good place to put my money or not. I think that investing in the long term, just based on trends and themes, is rarely a good way to make a really good return. That being said, if you're going to make any type of investment, your likelihood of losing money on that particular investment is lower if you invest in a rising tide. There's a common saying that a rising tide lifts all boats. And all that means in investment terms is that if the company you invest in is kind of lousy and it's just maintaining its market share or losing market share, that might not matter so much, and you might still avoid disaster if the market is growing so much that the company is still getting more business. If you want to think of it like a pizza, even if the slice you own kind of gets smaller and smaller, if the entire pizza is growing really fast and doubling and tripling, you might still have more pizza at the end of the day. But I'll keep repeating this until I'm blue in the face. If you're a long-term investor, the best way to make money without having to stay in front of a computer all day and reading business news all day is to just find high quality companies, buy them at a reasonable price, and then sit on your hands for years and years and years. And really, the only reason that you should ever sell one of those stocks is if the fundamentals start to deteriorate, aka if the quality starts to go down, or if you just find a better opportunity somewhere else. So sorry for the long introduction. In this video, I'm going to go over all 3 of these themes and explain why they're interesting themes to follow. And then I'll give a few examples of companies within those sectors that are high quality, could be of good value at the moment, and that are just interesting to keep tabs on in case they become of value in the future. Maybe we can even look back at the end of 2025 at these companies and see how the stories played out. That will be fun to do. Just remember one thing. For all the companies I'll be talking about today, these are not buy recommendations. All the companies I mentioned, I haven't done the due diligence on, and as a matter of fact, they're not even covered on my platform Rated A yet. This video is meant for me to just throw out some ideas at you, and if you find any of them interesting, make sure you do your own research before putting any of your hard-earned money into them. So, the first sector that I think is worth keeping an eye on in 2025 is online gambling. Now, I realize this is a sin sector, which means that a lot of people will not be comfortable investing into it, similarly to tobacco and alcohol. That being said, it can be quite advantageous for people who do not have such restrictions to invest in these sectors. Why? Well, because the value is usually chronically depressed. Because of all the ESG requirements and all of people's moral issues with these sectors, a lot of big money doesn't go into them. And as a result, the stocks of these companies tend to be cheap, often or always. And if you're a trader, well, that doesn't really matter because if you buy a cheap share, well, you'll get to sell it for cheap as well. You're never going to get that multiple expansion. But if you're just trying to acquire a company over time, being able to buy it for a lower price can be a good thing. The first thing to be said about the gambling sector is that it's undergoing lots of changes in the past few years. It's a highly dynamic industry, especially from a regulatory perspective. In 2018, for example, the Supreme Court in the United States made it possible for individual states to decide whether they would want to legalize gambling or not, online gambling especially, in their territories. And so that opened the door for more and more states to legalize commercial gambling and also online gambling. For example, we can see that New York has legalized every single type of gambling, and then more conservative states like Texas have not allowed commercial gambling or online gambling to take place. The key point here is that things are in motion and governments are more and more looking at their own regulations and saying, hey, maybe it would be nice to get tax revenue from here. And so the market for online gambling is growing at a astounding pace. And then there's a lot of other countries that have also relaxed their regulations regarding online gambling in the past few years. These include European countries like Germany, Portugal, and the Netherlands, Spain, and also South American countries like Brazil and Colombia. The second big trend that's favorable for this industry is technological innovation. All these gambling websites now have apps, and everybody has a phone with apps. And so it's never been easier to just gamble, pick up your phone and gamble on an event or on a sports outcome. You can really bet on anything. If it's a football game, you can bet on the score at halftime or who's going to score or which team. There's thousands of options on what to bet on. And also, these companies now have ways to entice people to pick up their phones with notifications, emails, and whatnot. Also, people are becoming more familiar and more accustomed to making transactions online. So it's not as shady to now pick up your phone and put some money into a betting account, especially if the website is highly recognized and advertises in many places. You don't feel like your money is in danger and there is some trust there. We also have to talk about the cultural normalization of all these gambling. All these gambling companies are advertising on public transport, on sports teams, leagues, whatnot. Partnerships are being created with professional teams. And even during broadcast or on television, you see bet now on this or that. And so it's becoming much more normal and less stigmatized to place bets on sporting events or presidential elections, for example. Finally, I have to mention the dark spot of this industry that everyone watching this video is thinking about right now, and that is human nature. Online gambling is super dangerous, super addictive, and highly predatory. In a way, for corporations, it's the perfect product. People get addicted and keep spending on your product. The one caveat I also need to mention, to be fair, is that governments end up making lots of tax revenue from all these sin sectors since they're taxed at a super high rate. At the end of the day, the reason why governments keep deregulating this industry is because they make a lot of money that they can then use on public projects like schools, hospitals, and whatnot. The first company within the online gambling sector that I think is very interesting is Evolution AB. This is a Swedish company, and don't be fooled by the market cap of 195 billion that you see here. This is in Swedish krona, their currency. Converted to US dollars, that's around 16 to 17 billion US dollars. So what does this company do? In very simple terms, it sells games to casino operators. So Evolution does not own its own gambling website or their own casinos. They don't actually interact with the end user. Instead, they partner with online betting platforms and they license live dealer games and RNG games. What do those two things mean? Live dealer is any casino game where you need someone that's present in order to be operating the table. So that would be games like roulette, blackjack, or poker. And then RNG games is just slots. So Evolution just licenses an API to all these games to online betting platforms. And then Evolution engineers come in, they do maintenance, they release new games, etc. In a way, it's more of a software business than a gambling business. So how does Evolution make money? Well, they take a percentage of the revenues that is generated by the online betting platforms. So this revenue is highly recurring and it scales along with the performance of the betting website operators. And I like to display this slide because we can see how quickly and consistently Evolution is growing its operating free cash flow over time. But if we look at the stock, the price is in a current downtrend, and actually it's down from its peak in 2021. That was almost 4 years ago that the stock has gone nowhere. And as a result, the PE ratio has gone from a high of around 70 at this point to a 14 at today's levels. Now, that's due to several things that are kind of scaring investors away. One of those being problems with regulations, like in the UK market. The UK is now saying that it's reviewing the licenses of some of the betting platforms that are partnering with Evolution. And so that's hanging on Evolution's business a little bit. Then the company has also experienced some strikes in Georgia, which is a country where the company has a lot of offices. Obviously, a low PE is not enough to know whether a company is a good value investment or not. If the company is trash, well, having a low PE will not serve you very well. The ideal setup is a company that has a low PE, but is also high quality. If we look at the company's financials, we can see that this company might be of high quality. The revenue is growing at a very steady pace. The net income is also growing at a very steady pace. Company has very little debt, lots of cash on the balance sheet. And then my favorite metric, and I think the most important metric, the free cash flow, it's growing really rapidly and consistently. So this stock might just be the rare combination of quality and value. But like I said, this is just a quick overview of Evolution. It's up to you to figure out if Evolution has a strong moat, what the future growth prospects are, and what the risks are related to this company. Okay, so another company that I think is quite interesting in the gaming sector is La Française des Jeux. This is a French company that was established as a national lottery system. And originally, this system was implemented as a way for the government to increase its tax revenues in order to pay the pensions of war veterans. The company in its current form only exists since the 1990s, and until very recently, it was fully owned by the French state. And then in 2019, the state decided to sell shares and privatize the company. So La Française des Jeux is now public, and France only owns about 20% of the company. So what does La Française des Jeux do? Well, they own about 3,000 outlets in little street corners all around France. And that includes newsstands, tobacco shops, or just betting shops. They also have an app for digital betting, but mostly what they sell is lottery tickets, scratch cards, digital sports betting, and that's mostly it. What's interesting about this little company is that the revenues that are generated from the lottery portion of the business, which is in dark blue over here, is a complete regulated monopoly. And that has to do with the fact that this company was owned by the French state for so long, and so they were really the only company that had a license to operate a national-wide lottery. And as you can see here in this chart, this segment is about 75% of total revenues. Now, the stock price for this one hasn't gone anywhere in the past 5 years, but the company pays a 5% dividend yield. The price to earnings ratio is about 15, and if we look at the financials, they also look to be pretty good. The revenue is going up over time. The free cash flow is going up over time as well, although not linearly. And recently, La Française des Jeux has decided to expand its digital betting segment and has acquired this company here called Kindred, which notably owns several big casino brands, including Unibet. I think that's their biggest one. So once again, this is a cool idea that I'm throwing in front of you. It's up to you to decide whether this is one that you would want to invest in, do your own research, decide whether La Française des Jeux has a moat, high growth prospects ahead of it, and what the risks are. Now, an honorable mention in the digital gambling space is Aristocrat Leisure. This is an Australian company that makes the slot machines and actual gaming machines for real life casino operators. From the stock price, it seems that this one might be a long term compounder. However, it's selling for a higher multiple than the other two that I mentioned. So we're now moving on to the second sector that I think will be good to follow in 2025, and that is private markets. It's very well known that private equity and venture capital are taking up more and more space in the investment universe. And simply, that's just because companies are going public and going IPO way less often than they used to. That's just the reality. Companies are now staying private for much longer. Why is that? It used to be that for a company to come into lots of money, lots of capital, they would go to the public and sell shares. But that comes with a disadvantage because when you list your company onto the stock market, you have to adhere to a lot of rules that are set by the exchanges themselves. So for a company, it's always cheaper and just easier from a regulatory perspective to just stay private. There are no regulators and there are no public shareholders that are always looking over your shoulder into your financials and all that to see what you're doing. Now, companies have access to capital in different ways, namely private equity and venture capital. And both of these entities are able to give companies the capital they need, and so there's no need to really go public. I'm actually quite surprised by the number of yearly IPOs. I was expecting it to be a bit lower. We can see that 2020 and 2021 were really aberrations when every single shit company was going public because they could, because public investors were willing to just give money out to whoever had an idea. And then after that, the IPOs normalized. But in 2024, we saw the same level as 2019, 2013, and all the way back to the middle of the 2000s. So I guess nothing to be too alarmed about. However, if we look at the total number of public companies, the total universe of public companies, it paints a different picture. This peaked in 1996. There were 30,000 public equities in the United States. Today, we're pretty much at an all-time low since 1980 of about 13,000. The reality is that the big money out there, the people that have lots of money and can invest in the private markets, they also are looking for diversification. I've been talking about it on my channel, but you know that the indexes are getting more and more concentrated. The big companies are getting bigger. They're also getting more expensive. The indexes and the market as a whole has never been this expensive in all of its history. And obviously, the more you pay for an asset, the less will be your return. So investors in private markets are also going there because the assets are cheaper. They can get really good assets for cheaper, and so their returns will improve. And I think the Trump presidency for the next 4 years will also be a big catalyst for this. I think the consensus so far is that Trump and his cabinet are going to be very lenient and very encouraging of M&A activity, mergers and acquisitions. What that means is that private equity is going to have basically a playground to do whatever they want to acquire, buy out, sell, whatever. Everyone's going to be on the market, especially big companies looking to buy smaller ones because there will not be any anti-competitive measures taken, most likely. As a matter of fact, a lot of banks that specialize in M&A, like Goldman Sachs, have seen their stocks surge in the past few weeks as the expectation of all this M&A activity kind of consolidates. The one thing that is not as ubiquitous in private markets compared to public markets is data. It's easy to know how much money Apple made in 2015. There's many analysts looking into that stock. There's plenty of platforms showing you the 10, 15, 20, 30-year financial history of that company. That's a lot harder to do with the little shop that's just at the end of the street. And so when there's a lot of trading activity on the market, lots of M&A, lots of companies getting bought out, where does the institutional money get their information? How do managers know how much, when, and where to invest? Well, there are a few companies that specialize in providing the data, the research, and the analytics for specifically this purpose. And actually, a lot of the companies I'll be mentioning in this little section come from this area right here, where it says market data and intelligence, companies, deals, and M&A. And actually, let me start with the honorable mentions. I think good stocks to look into for this sector are Factset, that you can see here, S&P Global, and MSCI is another one that owns one of these companies, but I'm not sure which one at the moment. These are all high quality companies that are quite expensive, but might be worth paying up for. The first company that I would like to highlight in this general sector is the London Stock Exchange Group. As the name suggests, the London Stock Exchange Group owns the London Stock Exchange, but it also owns the Italian Stock Exchange. These exchanges have been somewhat on the decline since Brexit and maybe even since the Great Financial Crisis. The way the group makes money from these exchanges is mostly based on transaction fees. Whenever a transaction occurs on the exchange, LSEG takes a cut from that transaction. But obviously, this depends on the amount of trades that are happening on the exchange, which depends on volatility and economic conditions. And so I wouldn't say this is a super high quality business overall. But luckily, LSEG owns many more things than just the stock exchanges. One of them being the FTSE brand that covers lots of indices. As a matter of fact, the FTSE franchise is MSCI's biggest competitor when it comes to making indices for international markets. And this is a high margin, highly scalable, high quality business. And that's not all. LSEG also owns Refinitiv, which is a platform that does data analytics and research on many companies, bonds, whatever, many financial instruments all over the world. This was a huge acquisition for LSEG, and you can see it in their financials. It happened in 2020. It's where the debt spikes up quite a bit, as well as revenues and free cash flows. The thing is, this Refinitiv acquisition today is the source of LSEG's future growth prospects. If you look in detail at the London Stock Exchange Group's financials, you'll see that Refinitiv is the segment that's growing at a very fast pace. As of today, Refinitiv changed its name to LSEG Data and Analytics, but you can see here by hovering over the data part that this platform really provides all types of data on commodities, companies, economic data, news, and market data. If you're an institutional investor that invests in private markets, this is a tool that is pretty much necessary for your job. So, LSEG is one of my two picks. I think it's a very high quality company, but it is quite expensive. And really, I'll repeat myself, it's up to you to figure out if this company has a moat, good growth prospects, and what are the risks involved. The final stock that I really like in this sector is none other than Morningstar. Morningstar is a relatively small company at only $14 billion. This company operates a mixed business model where they are both B2B and B2C. On the B2C side, they provide research and ratings to individual investors. And on the B2B side, they do exactly the same thing, but for asset managers and institutional investors. So Morningstar has a lot of financial products. They're mostly known for their star ratings, which are meant to give an indication of how expensive a stock is or a fund is. They were one of the first companies ever to provide ratings and research on mutual funds and ETFs. On top of that, they also dabble in investment management. So they take their clients' money and invest it for them. And then they also create their own indexes and also ESG research and all that. So the whole shabam, really. And on top of everything that I've mentioned already, the company is also present in private markets through PitchBook that you see over here. PitchBook is one of the largest databases for private market data for private equity, venture capital, and M&A. And it's also one of the fastest growing parts of Morningstar. It actually grew 23% in 2023. If we look at the company's financials, they also look good. The revenue is up and to the right over time, and so is the free cash flow. It looks like they've did some acquisitions in the past few years, but I have not looked into that. Up to you once again to figure out if those acquisitions were any good. The moat, the profitability, and the safety. I'm leaving that all to you. We've made it to the third and final sector that I think is worth watching in 2025. If you're enjoying the video so far, make sure to leave a like. It's completely free and it shows your support to the channel. And if you like financial content about long-term investing and passive income, dividend-paying stocks, well, you can subscribe to the channel and I release videos like this every week. Everybody knows that data centers are being built at lightning speed these days. And one thing we can be 99.9% sure is that there will be more data centers in operation in 2025 relative to 2024 and probably every single year thereafter. So this is definitely a very long-term secular trend. And if you can find companies within this sector that play an important role, well, you might just find yourself the next compounder. There's the chip makers that make the semiconductor chips that go and power these data centers. Those are obvious winners. And there's also the cloud providers, the ones that operate these actual data centers. So the chip makers and the cloud providers, these are all the highly successful companies that are probably very famous by now. You've heard of them. It's the Nvidias, the Broadcoms, but also the Alphabet, Amazon, and Microsoft. However, there are also companies that are not as famous, that work in the shadows, but are just as critical to keep these data centers running, especially when it comes to cooling and power generation. So secular trend number one, big data and analytics. We all know that we live in a big data world where data is becoming increasingly important in every walk of life. Businesses are increasingly moving things online and requiring data. And really every process, from banking to government applications, all of it is moving from analog to digital. And all of this requires enormous amounts of data. And all of this data, in order to be manipulated, requires data centers. But all of this is not as easy as just building a structure and putting some GPUs inside of it. You also need electricity to keep these data centers running. The problem is that we now have too much data, and the electricity required to power these data centers is just becoming more and more intense. The slide you have in front of you is regarding Ireland, and we can see that in Ireland in 2015, data centers were only taking up 5% of the total electricity. In 2022, this was bumped up to 18%. Today, in 2025, this number, I'm guessing, is closer to 30%. Because electricity and power are so critical and so important in the data center, well, the world is trying to find solutions to address this issue that will just keep growing and growing. One of them is finding alternative sources to power the data center. So nuclear has become a quite popular option nowadays. But if we stick to electricity, all it means is that we need to be better at managing the electricity so that less waste is done. That comes through cooling the data center efficiently and managing electrical waste. And so as you can probably imagine, the big companies like the Alphabets, the Microsofts, and the Oracles and the like, they're all investing heavily into renewable energy and to making their data centers highly efficient. And so we have to find the companies that are on the other end of that. The last thing I have here is that as more of the world and businesses are moving mission critical data online, it's becoming more and more important for these data centers to be reliable and have a very high uptime. Even small amounts of downtime can lead to severe financial losses and also reputational losses, like we saw last year with CrowdStrike. And so at the end of the day, the big cloud providers that have a lot of money, they also need to invest in protection from cyber attacks, but also hardware redundancy and energy backup systems. The first company on my list here is Cummins. This company serves a very broad range of industries from transportation to construction and agriculture, but it's also having a growing role in data centers by selling backup power generators. The generators that are sold by Cummins are pretty much necessary for when the power goes out or there's grid instability to keep the data center's operations running. The company makes diesel generators that are very popular because they're reliable and they can handle very large loads in an immediate fashion. So as soon as the power goes out, the diesel generator can take over right away. But now the company also makes natural gas generators, which are more environmentally friendly. And so, from an ESG perspective, you could see how companies like Microsoft, Oracle, and Amazon would be willing to invest in these types of generators. And then on top of that, the company sells many other solutions from batteries to hydrogen power to switches, everything that's necessary regarding power generation and management. If we look at the company's financials, the revenues and the cash flows were both up by quite a bit last year, and I think there's a good chance that this trend may continue over the next few years. If we look at the stock itself, it has a dividend yield of 2%, a PE ratio of almost 24, which is relatively high but not too demanding still. And once again, I'm realizing I'm not spending a lot of time analyzing this stock, and that's because I really haven't. And that's also why you should do your own research before putting any money into Cummins. Another thing that I forgot to mention about this company is that they love to buy back their own shares. I really like that because as an investor, it means that without putting any more money in, I get to own more and more of the company every year. The last company I'll be talking about here is Trane Technologies, ticker symbol TT. This is an $86 billion company with a PE ratio of 35 and a dividend yield of 0.87%. Now, according to the description here, the company is focused on heating, ventilation, air conditioning, and refrigeration systems. Now, the thing is about data centers is that they generate a lot of heat. You have all these servers and these GPUs and all this hardware that's running with a lot of power 24 hours, 7 days a week. And so if you want to keep your data center up and running and you want to prevent, your hardware from overheating, you need to have measures in place that will cool down the hardware. According to what I've read, power consumption is one of the biggest problems for data centers. And actually, cooling down the data center accounts for most of this power expenditure. What Trane Technology offers is a bunch of solutions to be able to cool down the data center in a cost-effective way and environmental friendly way. For example, by bringing cool air from the exterior into the data center, or by targeting specific hotspots in the data center instead of cooling the whole thing together. If you're a big company with lots of data centers like Microsoft or Amazon, it might be really beneficial for your overall cost to actually invest in Trane Technologies' products. If we look at the financials for Trane Technologies, the revenues are really constant, but they're not growing that fast. It seems that the free cash flow is growing a little bit faster. I think what's more important here is that the return on invested capital just keeps going up over time. So despite the company not making that much more money year after year, they're managing to get more bang for their buck when they make investments. And once again, just like Cummins, something I really like about Trane Technologies is that they keep buying back their shares. Once again, I'll say it one last time, make sure you do your own due diligence because all I've done is look up for some tickers and some financials for companies within sectors. I don't know these companies all too well. If you're not too comfortable doing your own research, however, or if it's not something that you're super motivated to do, that's fine. The companies that I mentioned in this video will be the first ones to be added to the coverage on Rated A this year. I'll leave the link to the platform in the description below. You can try it out. It's free for a week and you can cancel anytime, so there's zero risk. And here are some honorable mentions for the data center build-out theme if you want more stocks to look into. One of them is Vertiv Holdings. We've got Schneider Electric, a French company, Eaton Corporation, and last but not least, ABB. All right, folks, that's it for this video. I hope you enjoy it, and I'll see you in the next one.